In this recording, we're going to look at August MixMax. You have your balance sheet and all of the general sort of things that we did to set up the Taccounts. But in addition, there's another assignment in the August MixMax, and that is to set up spreadsheets for a bond. So you have numbers given to you. It's going to be a little different because you're asked to do it semi-annually instead of annually, so that'll change some of the formulas a little bit. And then also write out the journal entries throughout the life of the bond. And you don't have to complete that in Excel, but you can if you'd like to. But you do need to turn in 3 spreadsheets that have all of this, the data input and then the amortization schedule itself, and using these numbers. Now, I am going to challenge you just a little bit more. Here you're usually having to type in either premium or you type in discount. I will give you 5 bonus points or extra credit points if you can figure out how to use the if function so that either premium will show up or the word discount will show up here using the if function. Recall, it's a logical function, so you say if, and you give it criterion, and if this is true, then it'll print premium, or if it's false, it'll type discount for you. So again, just some extra bonus points if you can figure out how to use the if function for that. And if you don't want to bother with it, that's fine because it's just extra stuff. Okay, the other thing I want to go over are working through the question marks. So I'd like you to try to figure out these question marks yourself and see if you can solve for those. And I will give you one clue. You want to start here with the cash flow statement. Okay, so I'm going to stop and see if you can put those together. Okay, the first one that you should be able to solve for is this repayment of the loan. So you have to think about, well, where else on the financial statements do we find information about loans? Well, that would be the balance sheet. And this current portion of debt went down during the accounting period, or during the month, and that difference is $585. And the reason it would go down is because they made a payment of $585. So we're going to go over here and we put our payment or cash outflow of $585. When we do that, this will net to $44,415. And then the total change in cash would be $28,000. Okay, so those will be the first 3. Once you know the change in cash, now I can go back over to my balance sheet. I know the difference is $28,000. Once I know that, I can solve for, well, what was the ending balance? The ending balance had to have been $69,000. 41 minus 69 gives us a difference of $28,000. And then I can add up all of these numbers to get $214,160. If total assets is that amount, then total liabilities and stockholders' equity is that amount as well. And then for liabilities and stockholders' equity, there's only one number missing. So we can, add all of these, subtract that from the $214,160, and I'll get $48,575. So now we have finished solving for the unknowns on the balance sheet. For retained earnings, keep in mind this beginning and ending balance. That will help us solve for net income. So on the income statement, again, beginning retained earnings was $69,400. Ending retained earnings was $75,700. And that is a difference of $6,300. So the difference between beginning and ending is net income. Now, it's also possible that dividends could have been one of the changes, but then when I look down here under financing activities, there are no dividend payments. So the only change in retained earnings is due to net income. Okay, once I know that, then I can go back up. Income before income tax expense must have been $10,500, and then interest expense had to have been $860. So then I'm all finished with that. Okay, so that solves for the unknowns. Now, I also want to address the new kid on the block for this assignment. Has to do with bonds. So bonds would have been issued at $45,000, and it's really kind of an odd entry because they're telling us cash came in for bonds of $45,000. And then bonds payable would have been credited for the face amount of the bonds. Well, let's go to the balance sheet because we put the face amount of the bonds in the bonds payable account. And it's an odd number. It says $48,575. That's odd because usually we're used to the issue price being the even number, being the odd number, and then the bonds payable having this nice smooth, like $45,000 number. But it's not that way in this case. So face value is $48,575. So that tells me that the bonds were issued at a discount, $35.75. I need a debit to balance, and that would be the discount. Okay, so let's move to the T accounts and kind of look at, how's this all going to play out when we get to there. So we know the process for MixMax now, solve for your changes in your balance sheet accounts. Well, I'm going to focus on just a few of those. You will discover the change in interest payable is $399. The change in the unamortized bond discount is $3,530. By the way, MixMax just calls it unamortized, but it's the bond discount account. And it happens to be unamortized. That's why they use that description. And then bonds payable, $48,575. So I want to post the entry we just made. We had a debit to cash of let me put that in blue, $45,000. That's not working out the way I meant. So under financing activities, there would have been an entry to issue the bonds. So sale of bonds, issue the bonds, same thing, sale or issue of bonds. We credited bonds payable, $48,575. And then also there was a debit to unamortized bond discount of $3,575. So we had the debit of $45,000, debit of $35.75, and then this credit, $48,575. Okay, now I also want to talk about, you're going to have an entry over here so you're going to enter in the changes in the balance sheet, then you journalize your income statement. And when you make your entry for interest expense, let's look at that. So interest expense is going to be $860 in this case. Okay, so what's going to happen if you think back to our lecture on interest expense? It actually, if you go back to your notes, it was 3 accounts. It was interest expense, it was cash or interest payable, and then also if there was a discount or premium, we debited or credited that. With it being a discount, we can see this account is not in balance, and actually we need $45 here, right, to get that up to $35.75 to equal the crisscross. So we need to credit the discount, $45, and then we can solve for the dollar amount of cash. Of course, actually, in this particular case, the credit is not to cash. The other related account, we have 2. One is interest payable, and the other is this bond discount. So we want to credit interest payable. We're just going to plug that dollar amount to get this to balance, and that's going to be $815. So then we'll post that as well. And then, you're going to finish this out, figuring out, well, what was the cash amount paid out of the interest payable account for our cash paid for interest, okay? All right, so that's setting that up and what to do with the bonds payable, how is interest expense changing now? All right, I do want to remind you on this indirect approach, there are really the 6 steps for that. Starting with, we're going to start with net income as step number 1. Step number 2 is remove anything that's not a cash flow on the income statement. So that's usually adding back depreciation expense. We want to remove anything that's non-operating activity on the income statement, and those are the gains and losses from sales of property, plant, and equipment. Step number 4, factor in your changes in your working capital accounts. And we do that because the working capital accounts, those current assets and current liabilities, are connected to the various revenues, operating revenues, and expenses on the income statement. So that's why that's part of arriving at cash from operations. So we just plug debits and credits in this part. The change, so interest payable had a change of $399. Since that's on the credit side, you come down here and put it on the debit side. The other new thing for this term is that we factor in the changes in the deferred tax liability account. And we do that because that is connected to income tax expense. So even though it's a long-term account, we have to factor in the changes for that because that's connected to an expense account. We've also just discovered another long-term account that is connected, so we will factor in as part of step 5 changes in the bond discount. If it had been the bond premium, we would factor in the changes in the bond premium. And we do that because that is connected to interest expense. It's one of the two accounts, balance sheet accounts. It's one of the two balance sheet accounts connected to interest expense. And then number 6 is solve for cash from operations. So just a reminder on that, and again, the new kid on the block for August is this bond discount and factoring that in. I don't plan on creating a recording working all the way through this, but I will post the solutions to the August MixMax for you.